If your foundation isn't strong, nothing else matters. That is exactly why I'm starting from scratch. Now, let me be honest with you. CRT is one of the most misunderstood concepts on the internet right now. Not because the concept itself is complicated, but because people online, the so called gurus, have completely distorted it. They throw around random terms, add their own twists, and end up confusing everyone. So, what we are going to do here is different. We are going to remove the noise. We are going to strip away the confusion. And I am going to show you what CRT actually is, step by step, in a way that truly makes sense. This mentorship will run for approximately 3 to 4 months, covering the first quarter of the year. Every single week, I will upload at least one episode. And if I see your support, your effort, and your seriousness, I will push myself to upload 2 episodes per week. But there is one very important thing you need to understand. Nothing in this mentorship is random. If you are someone who watches videos at 2x speed, skips half the content, or plays them casually in the background, this mentorship is not for you. You will not learn like that. But if you are serious, if you sit down with a notebook, watch carefully, and go through every single second, then you are on the right path. That is how real value is built. That is how real growth happens. So, yeah. All right, that's enough. Let's get to work. CRT, candle range theory. You've seen this term everywhere. You've probably heard people talk about it, and you've definitely seen it floating around online. But here's the truth: almost nobody actually understands what CRT really is, except Romeo. And that is exactly what we are going to change in this mentorship. Now let's move into the real technical side. Every single candle you see on a chart, whether it's a daily candle, a 4 hour candle, a 1 hour candle, or any other time frame, is not just a random shape. It is a range, a time based range. Think about it for a moment. When you zoom into a lower time frame, what do you see inside that one candle? You see a smaller range forming with a clear high and a clear low. That's what every candle truly represents: price moving within a defined range during a specific period of time. This is where most people get lost. To understand the market, the algorithm, the so called smart money, you do not need 1,000 tools, indicators, or complicated concepts. You only need to understand three things: liquidity, time, price. That's it, nothing more. And the most important part is this: all three of these elements are perfectly wrapped into one system: CRT, candle range theory. All right, let me break this down for you. First, liquidity. The market always moves from liquidity to liquidity. Either it takes buy side liquidity and then runs towards sell side liquidity, or it does the opposite. It takes sell side liquidity and then moves toward buy side liquidity. This is not random. CRT gives us a clear framework to understand this. The candle range or CRT high represents buy side liquidity, and the candle range low represents sell side liquidity. For now, just keep this idea in mind. We will build on it later. Next, time. So let's talk about time. Now, every candle forms within a specific time window: a daily candle, a 4 hour candle, a 1 hour candle, whatever the time frame is. Each one has a defined open and close. That open and close represent a time based range. The market is not just moving in price, it is moving within time. Now, the third and last thing is price. The candle itself is the price range, from high to low, from open to close. That is your structure, that is your data, that is what the market is giving you directly without any indicators. So always remember this: liquidity plus time plus price is equals to time based ranges. This is the backbone of the entire CRT system. All right. Now, before we go deeper, let's talk a little bit about typical or conventional ranges. And the reason for this is simple. I want you to clearly understand the difference. When you understand both, your conviction in CRT will become much stronger. Here's the real problem with conventional ranges. First, the highs and lows are inconsistent. It's never clear which high or which low actually matters. Everyone marks them differently, and that alone creates confusion. Second, there is no fixed opening and closing time. With typical ranges, you never truly know where the range starts or where it ends. It's subjective. Two traders can look at the same chart and draw two completely different ranges. Third, There are no fixed targets. Conventional ranges don't give you clear objectives or clear liquidity draws. Most of the time, you're not trading with precision, you're just guessing. And that's exactly why CRT is so powerful. All right, that's enough talk about typical ranges. Let's get back to candle ranges. Every single candle you see on a chart is a range. Whether it's a monthly candle, a daily candle, or a 1 hour candle, they all have the exact same structure: open, high, low, and close. That's it. A monthly candle is not special compared to a 1 hour candle. The only real difference is speed. A monthly candle simply moves slower, but the principle is exactly the same. And this is the true meaning of fractality. Price is fractal. Whatever you see happening on a higher time frame will also happen on a lower time frame. The structure stays the same, only the speed changes. Now, the real reason candle ranges are so powerful is because they are objective. Unlike typical ranges, they give you fixed highs and fixed lows, clear reference points. They also have a fixed opening time and a fixed closing time. That means you always know exactly when the range starts, when it ends, and where its boundaries are. You're not guessing anymore like you do with conventional ranges. And because of this structure, candle ranges also give you fixed targets. Every candle has a high and a low, and those highs and lows are liquidity pools. The market will either raid one side or the other, and that behavior is what gives us our entries. Now, with every candle range, there are only two possibilities. The first possibility is that the range is truly broken. That means price breaks above the CRT high or below the CRT low and continues in that same direction. The second possibility is that the range is falsely broken. This is when price raids one side of the range, what we call a turtle soup, and then reverses and runs to the other side of the range. And this second one is the most important one. This is the foundation of CRT. Price opens, soup one side of the range, and then declines or expands toward the opposite side, eventually targeting the range low or the range high. Once you truly understand this behavior, the entire picture of CRT starts to become clear. This is the foundation of candle ranges. And when this foundation is clear, everything else in CRT becomes much easier to understand. I hope there's no confusion left about the basics of CRT, but even if there are still questions, Sue, don't worry. As we move deeper into this mentorship, step by step, everything will connect naturally, everything will come together, then it will start making a complete sense. All right, now let's move on to the next part: types of CRT. When it comes to CRT, there are different variations, but to keep things simple, we can group them into three or four main types. Out of all of them, the most important one, and the one I personally like the most, is the three candle CRT. As the name suggests, it's built using just three candles. The first candle creates the range. The second candle is usually where manipulation happens. This is where you'll often see liquidity purges, raids, or what we call a turtle soup. Then comes the third candle, the distribution candle. This is the candle that expands price toward the opposite side of the candle range. So the structure is simple: accumulation, manipulation, and distribution. But here's the key point: we do not treat every set of three candles as a CRT. A proper CRT must follow specific rules. It follows a clear protocol and has very specific characteristics. That's what makes it objective. And this is where time theory comes into play. For example, if you zoom out to the weekly chart, you'll often see this structure very clearly. Week 1 acts as the range, week 2 becomes the manipulation, and week 3 delivers distribution, a clean run toward the opposite side of the candle range. The same concept applies on the daily time frame. Monday sets the range, Tuesday is manipulation, Wednesday delivers distribution or expansion. Even on the 4 hour chart, the structure remains the same. The 1 a.m. candle forms the range, the 5 a.m. candle gives manipulation, and the 9 a.m. candle provides distribution. This is what we also refer to as a core model, and we'll break this down in much more detail with real examples throughout this mentorship. Now, the second type of CRT is the two candle CRT. This one is very simple. The first candle creates the range, just like always, but the second candle does both jobs. It sweeps or purges liquidity, meaning it takes the high or low of the range, and it also distributes in the same candle. This type of CRT often appears during major red folder news events when the market doesn't waste time forming three separate candles. Everything gets compressed into one strong move. The third category is multiple candle CRT. These usually appear in two main forms: inside bar CRT and outside bar CRT. Okay, now, in an inside bar CRT, the first candle sets the range. The candles that follow remain trapped inside that range. It's not limited to just two or three candles. Sometimes you'll see five, six, or even more inside candles. In this situation, your job is patience. You wait until the market purges one side of the range. Once that purge happens, distribution follows. In an outside bar CRT, the structure is slightly different. The first candle creates the range, the second candle purges the high or the low, and after that, multiple candles continue distributing price toward the opposite side of the candle range. Now, why am I explaining all of these variations? It's not just theory for the sake of theories. The point is, CRT is not limited to only three candles, it has different forms, and the market will show you different versions depending on conditions. When you understand these variations, you won't be stuck with a narrow mindset. You'll be prepared for whichever version the market decides to present. Now let's talk about CRT with key levels. Key levels in price action are important zones where the market often decides whether to expand or reverse. And when we're talking about higher time frame key levels, those levels carry even more weight. Most of the time, manipulation and expansion phases are built around these levels. That's why the most reliable CRT setups usually form near key levels. Integrating key levels with candle ranges is what makes CRT so powerful. Okay, now, the black line you see here represents a key level. Some of the most effective key levels include order blocks, fair value gaps, breaker blocks, rejection blocks, and of course, major highs and lows. Now look closely. The market first formed a candle range just below a key level. Whenever a range forms in this position, it naturally builds liquidity on both sides: buy side liquidity above the range and sell side liquidity below it. This is how the market sets its trap. Participants position themselves on both sides, expecting expansion in either direction. Next, price moves up and purges the CRT high. In doing so, it clears buy side liquidity and taps directly into the key level, and then rejects from that key level and closes back inside the range. At this point, the manipulation phase is complete. One side of liquidity has been cleared, and rejection from the key level has been confirmed. From here, the expectation shifts to the expansion phase, where price is likely to move toward the opposite side of the CRT, in this case, the CRT low. This sequence is a textbook example of how CRT works together with key levels. First, the range forms, then the purge happens, then the reaction at the key level, and finally, the expansion toward the other side. Now look at this. The market forms a candle range just below a key level. This automatically generates both buy side and sell side liquidity. Dumb money starts placing stops and entries on both sides, waiting to be taken out. Then comes the second candle. What does it do? First, it purges the CRT high, taking out the buy side liquidity above the range. At the same time, it taps directly into the key level. But here's where something different happens. Instead of pausing or closing back inside the range, the second candle immediately expands lower in the same move, driving straight toward the CRT low. In this scenario, the second candle does double duty. It doesn't just handle the manipulation phase, it also completes the expansion in a single strike. That's why this structure often appears during high impact news events, when volatility is strong enough to sweep one side and instantly run the other. This teaches us an important lesson. While the classic CRT usually plays out in three clear steps: range, manipulation, and expansion under certain market conditions, especially during news driven moves, the second candle alone can complete the entire cycle. Okay, now that we've gone through the graphical examples, let's move to a real chart so everything becomes more clear. In this first example, You can see the gray box, which represents a key level. Just above this key level, the market formed a candle range. The first candle created both buy side and sell side liquidity. And from here, our first expectation should be that price will purge the CRT low and test the key level. And that's exactly what happened. Price moved down, purged the CRT low, tapped into the key level, and then closed back inside the range. After that purge, your focus should shift to the lower time frame, looking for an order block or a Model 1 entry forming inside the second candle. Now, some of you might be wondering which lower time frame should be used for the entry. We're not going to rush that yet. We'll go step by step. In the next episode, I'll break down lower time frame methodology, entry models, and time frame alignment in detail. For now, I want you to clearly understand the relationship between CRT and key levels. Okay, let's look at another example. Again, the gray box represents a key level, in this case, a rejection block. Just below this rejection block, the market formed a candle range. The first candle built liquidity, then the second candle purged the CRT high, tapped into the key level, and closed back inside the range. That completed the manipulation phase. And immediately after that, the third candle expanded lower, running straight toward the CRT low. Here you can clearly see the phases playing out. The first candle forms the range, the second candle creates manipulation, and the third candle delivers expansion or distribution. Now let's talk about a two candle CRT. Once again, the gray box marks the key level. The first candle forms the range just below it, creating liquidity. Then the second candle comes in, it purges the CRT high, tests the key level, and immediately expands lower toward the CRT low. Right? In this case, the second candle completes both phases, manipulation and expansion, in a single move. That's why it's called a two candle CRT. Now next, we have multiple candle CRT. Here, the first candle sets the range, as always. Then the second candle purges the CRT high, taps into the key level, and closes back inside the range. That completes the manipulation phase. But instead of expanding immediately, the market starts consolidating, creating multiple candles inside the range. And then, finally, the expansion phase begins and price drives toward the CRT low. The important point here is this: CRT is not limited to just two or three candles. Sometimes it plays out very quickly, and sometimes it takes more time before expansion happens. Your job is to stay patient and wait for the manipulation phase to confirm the setup. Now, in another variation of a multiple candle CRT, you'll see the market form the first candle as the range and then continue consolidating inside that range for some time. After that, the market finally purges the range high, taps into the key level, and then expands lower toward the CRT low. So again, the process is always the same: range, manipulation, and then expansion. The only difference is how long it takes. Sometimes it's fast, sometimes it's slow, but the structure always remains the same. So, yeah, that's it for the first episode. We covered the foundation and the basic understanding of CRT. Uh, and trust me, once you really understand this foundation, the rest of CRT will start falling into place naturally. Remember, every advanced concept we'll study later is built on this simple idea.